Hello, Propenomix people. Good afternoon. And hello to Property and Propenomics people as well. So, if you haven't listened before, well, first of all, if you'd like to comment on the shirt, that would be very welcome. I wonder what the assembled company think of it. A little bit of something to grab your attention. But if you haven't watched before, I'd like to start with a quote. And this week's is Britain faces an acute challenge from its weak economic underlying growth and a drop in the number of workers since the pandemic. That was from Andrew Bailey, the Bank of England governor, in late summer this year, 2025. And of course, as usual, the quote pertains to the deep dive, as it often does. And I go deep into the recent Bank of England monetary policy report this week and the details and the nuggets that it contains within. So, as the calendar creeps towards a new year, it's a natural time to pause and tackle the biggest challenges that keep small to medium enterprise property businesses from achieving true sustainable growth. For most, this boils down to two core areas: laying a bulletproof strategic plan for the next 12 months and finally cracking the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling short, it's time to switch from doing to leading and truly understanding how your assets are performing. Book in on the next property business workshop with myself and Rod Turner, live in the flesh, Thursday, the 22nd of January, 2026, Central London. There's a link in the show notes, and it's also at tinyurl.com/PBWNINE. So, as I usually do, I'm kicking off with Trumpwatch, the sorts of contra deals that are rife within the 10 biggest companies in the world right now. And they just sniff as though they're a little bit bubbly. After all, you can make commitments and even sign contracts, but if you don't have the money and the bubble bursts, where are you going to be then? They also seem to be happening at the international level. So this week's example was the EU committing to $750 billion in US energy purchases and $600 billion of investments in the US by 2028, in exchange for a 15% tariff, a break in other words, on certain American goods, and a 0% levy on American tariffs. When you look at it objectively, it's very hard to argue that Donald Trump hasn't got the better of that one. And very little of the analysis of tariffs is non-partisan enough to admit that it isn't really about the tariff, which is, of course, a blunt and inflationary tool, but it's about the leverage that it gives in trade negotiations. There is merit to the point that this is a short-term gain here, and long-term it will do damage. But actually, I do disagree with that as well to an extent, to be honest, because once Trump is gone, they can then put the blame on Trump instead of it being a continual stain on the US and trading relationships. Of course, trust takes time to rebuild, but Trump is that much of a one-off. Then the next candidate, the next lucky winner, if it is a winner, then they can probably just blame it on Donald and get away with it to an extent. If the next president, on the other hand, is J.D. Vance or a carbon copy of Donald Trump who doesn't have their own policies, there's no guarantee that would be Vance, of course, well, then it would start to be very problematic, wouldn't it, from a medium long-term game theory perspective, in the view of pretty much anybody who understands too much about international and trade economics and game theory as well to boot. And the Swiss did the same as the EU, a cut from a 39% maximum tariff to a 15% maximum tariff was based on a $200 billion commitment to direct investments in the US by 2028. Oh, and there was that engraved gold bar as well. If you saw that, nice little tickle there. Let's not forget who they're dealing with here, so it all makes sense. Pay your tribute, folks. And global aid took an absolute beating as the US administration implemented direct cuts to foreign aid, including cancelling 80% of USAID contracts and closing the agency. Makes you understand how the other 20% of contracts will survive. You do wonder. Pressure goes on to the UK and EU to try and maintain a multilateral global aid system. And this fits within Trump's NATO philosophy portfolio for me. The US doing more than their bit and their allies not doing enough. But on the political front, 4 European networks on the left wing in Italy, Greece and Germany were designated as FTOs, foreign terrorist organisations. Their anarchist Marxist ideologies, including anti-Americanism, was the stated reason, and their past use of violence. On the other hand, and on the other side of the fence, Orban got an exemption for Hungary so they could continue importing Russian energy, presumably just because Trump likes Orban so much. Well, what can you say? You also won't have missed the lawsuit threats against the BBC, who've had to deal with major league embarrassment here, $1 billion was mooted as sorting it out, although the latest quote is up to 5 billion now. Sorry doesn't seem to be the hardest word here, but it also comes at a rather convenient time, one might note, with 23,000 plus emails released that are simply dismissed so far as, of course, fake news from the Epstein estate. Totally unrelated, going after a national broadcaster in that sort of week, of course, the issue that you often end up with Trump is that he's clever in a different sort of way, and he's a very, very, very tricky person to take on. And his heavy-handed tactics work, ultimately, in the short term. That is just the reality of Donald Trump, especially 2.0. Anyway, back to the knitting. The UK real-time property market. Chris Watkin, our stats hero, smashed in a big week 44 as we look at that real-time market. Listings printed 27,100, down only 400 on last week. The market now will continue to slow down towards the end of the year. It's the nature of the beast and the cycle. The average week 44 saw 28,000 homes listed, so that balance is still continuing to redress a little. It will be a slow process though, and another clear out at the end of the year, followed by the usual Boxing Day action, will tell us more about where we're at. Although listing overperformance does look over and will drop out of the figures in about 9 to 10 months' time, is my sense. It will drop out that year-on-year data anyway, of course, to clarify. But my 10% more stock than a normal market ready reckoner is continuing to work on the back of about 2 years worth of overperformance in listings compared to historical averages, and only having had a few weeks since those peaks have we crept back towards those historical averages. There have been 1.56 million homes listed this year so far, 8.9% ahead of the 9-year average. Well, that does include 2020, so we do need to bear that in mind. But we're really inching back towards those 2024 numbers now, week by week. We were nearly 7% ahead of them at one point in the year, but now we're listing more than we're selling still. So it's still about the withdrawals and the net sales rate, ultimately, that is defining how much stock is on the market. Only 1.4% ahead of the 2024 listings year to date now, but still that 8.9 ahead of the 2017 to 19 average. And week 44 historically is a pretty flat, uniform one as numbers go. And this one was nothing special, but we did list 5.2% fewer homes than we did in week 44 of 2024. So it looked a lot like a pre-pandemic week 44. So a real sign of reversion to type, really, to an extent. How about price reductions in week 44? Well, 18,500, a tick up from 18,300 last week, and still a fair gulf from the numbers being big numbers that have been reduced in 2025 in general. People are hunkering down for Christmas. October's completed number was 12.8% of existing stock reduced, compared to September's number of 14.1 for reductions. August's 11.1 still looks like a summer anomaly. So numbers came back to the 14.1 reduced in July as well, 14% in June in comparison to last year's 12.1. But we are seeing less and less, as you can see. So 13.4 average in May, 10-year average is only 10.7, and this year's average has still been 13.2. Now, I think October's number might be a bit more reflective of people not even listing in the first place for more expensive stock, because that's what the average price of new listings was suggesting. So if you're not in on that stickiest part of the market, you don't need to be reducing as much, of course. Overall, though, more stock means more reductions, absolutely and relatively. I'm still working on the basis of a ready reckoner of 25% more properties reduced than in a normal market. If anything, that's been an underestimate because of the extra stock out there. And, you know, we talk about the monthly figures when we say 12, 13, 14% reduced. So given that the average one stays on the market 5 months before it's sold, but of course, that's most of that is during when the sale is agreed. You're still talking sort of 2.5, 3 months on the market for the average one to get there, by which point there's at least a 25% chance of these numbers, it's been reduced. So 22,500 homes sold subject to contract, healthy enough. The 2025 average 26k, but we would expect it to be lower in a week 44. And indeed, the historical 9-year average of week 44, 22.7k. So there or thereabouts, really. Still 3.9% up year on year, 12.5% up on 2017 to 19. And we will stay ahead of 2022 now because we're past the day of the lettuce and we're into the aftermath territory. Sold subjects up 3.9%, and remember listings are only up 1.4%, so still more intention to transact than 12 months ago, or just a more functional year than 2024 really, even though we had the stamp cliff to deal with, or stamp reintroduction, as we might call it. This is the second best year for 9 years, behind 2021, which is a phenomenal year for gross sales. Week 44 of last year was actually more buoyant, but this was considerably better than week 44 of 2023 and 2022, which were tougher markets, of course, by that point in the year. Anyway, we went into November with just over 742,000 homes on the market. October's number on October the 1st was 751,797. So a net drop of nearly 10,000 homes. So the numbers look like a fairly slowish October for net listings, and that's what we've seen and we've commented on as we've come back towards that norm and actually dipped a little bit underneath it. Nothing extraordinary. We aren't back to the peak of 763,000 in early August. It really does look like that 763,000 homes was absolutely the cycle peak. But for context, as the market got stickier before the pandemic, you were looking at more like 660,000 homes on the market, and a seller's market would more likely be under 600,000 homes on the market. If we were defining that seller's market from the supply side, there does need to be demand, of course, as well. But there usually is demand hoovering up those homes, which is why there aren't so many on there. We saw an extreme version of that during COVID, of course. The ongoing figures will be interesting. October 2024 ended with about 725,000 on the market. So we've only got 17,000 more homes on the market at the start of November this year than last year. And only 2.4% more properties that ultimately boils down to. Chris also looked at the per square foot on sold subject to contract properties. October sales agreed was £343.18 per foot, a massive leap on September's number. So large, I have to actually check in with Chris to check he hasn't changed his methodology. But there was a big increase in the Halifax price index as well, which caught a lot of people by surprise, but not quite that big. September saw sales per square foot pricing 336.54. So that is a big old jump, right? But we've seen these numbers before in this year. June, July, we were in the sort of mid 340s, and actually June's number, sold subject to contract per square foot, was 346.45. So we're still not back to there. And you don't normally end the year much stronger than you were in the height of the summer. But let's see. And remember, this with a 92% correlation, predicts the direction of travel of the land registry 5 months hence. So ultimately, June's number becomes November's ONS number when that report is published, which is January 2026. I normally wait until December's number for 2025 at the ONS, which is February 2026, by the time we really know what did the market do last year. And of course, being an ONS stat, it's still revised on an ongoing basis for at least 6 months, sometimes years and years. These stats continue to be revised for. So sometimes you look back and it's changed, even if you tried to commit it to memory. It certainly happens to me anyway. So not quite back to June or July, but it looks like a bigger than usual summer adjustment, nearly there. Fall throughs popped up to 26.5%, which is relatively high, really. But 6,000 or so fall throughs a week, it might just be a bit of noise. The long-term average is 24.2. Let's see next week's number, and I don't see a particular trigger for this at this time. The net sales were therefore a little bit weak, 16,600, 3.4% up on last year to date, 9.4% higher than 2017 to 19, now leapt above 2022 levels, more than 35,000 in front now. Week 44, 9-year net sales average 16,900, so we dipped a couple of percent under that. Now, Chris Watkin always gets this weekly shout out here from me because he's much more prolific than just this epic tome that I've just tried to summarise for you on the UK property market, which he releases weekly. He's got great stats on a regular basis. Drop him a like, a subscribe, all the rest of it, and some kind words for his content creation. If you're in the industry and want support growing your business or to be a more effective communicator, be more in touch with your local market, that ultimately is what he does. So give him a shout. His article goes on the Property Industry Eye website weekly, and he's got his own YouTube channel at Christopher Watkin. And if you're feeling in a good mood, also drop me a like, comment, subscribe, follow, and all the rest of it if you don't mind. Thank you. So what about this week's macro? What's in the macro chain as the economy looks like a 10-long series of transactions at the moment, with sticking points at the top, in the middle, and at the bottom? Well, we've got the ONS labour market report. You might have heard about that one because it was an upside miss on unemployment, and we crossed a significant threshold. The RICS house price balance, and then the growth, of course, a free electron microscope with every reading of the growth report for Q3. Only joking, of course, but you need one to see the growth, is the point. And then Gilts and Swaps to round us up. Of course, you knew that anyway. So unemployment, 5%. The expectation was a continued rise in the trend to hit 4.9. It doesn't often move by more than 0.1 in a month, but August does often leave some strange effects behind. So September is a month where we might expect a bit of a jump. We did have a bit of a jump last September, actually, after August. So always got to be a bit cautious. It rose actually 0.3. It went from 4 to 4.3 in 1 month last September. And that was reversing the long-term trend that was that unemployment had been falling for a few months in a row. Now, there's always a nowcast figure in the report for job creation or loss during the more recent month. So this is October's figure, whereas the report is reporting on September. And their nowcast figure is a loss of 32,000 jobs on the month and 180,000 jobs on the year. This hasn't been a particularly accurate number in recent months and years, but it is obviously in the wrong direction. The ONS uses various measures for unemployment, and the fear is that we can't trust any of them as much as we'd like to, but estimates are that between 109,000 and 117,000 jobs have been lost between September 2024 and September 2025. Now, regulars will know that I like to look deeper. That's kind of the whole point of doing these videos. And the employment rate dropped to 75%. So 3 or 4 people, 16 to 64, are employed. Doesn't mean full-time employed, of course, it means employed. Work about an average of 30 to 31 hours a week because all the part-timers are mashed in there as well, of course. And what about the inactivity rate? That's the one for me, staying at 21%. So as usual, all those 3 variables added together add up to 101%, which is a bit frustrating, but we don't have an age bracket for unemployment over, so it doesn't go 16 to 64, it carries on if you're still seeking for work. It's becoming more and more of a problem for these figures because these age brackets are before your 65th birthday, but we started to raise the pension age in April 2010, so we're 15 and a half years after that, so it seems a little bit silly. If the unemployment rate was also 16 to 64s, the other way to look at it is it would only be 4% if we assume 75% employed, 21% inactive, or 20% of all unemployment is people 65 and above looking for a job. Now, that in itself sounds a bit ridiculous to me. I don't know about you, and I don't know the answer to that, but that does seem wrong. And perhaps that's why they just leave the problem alone at the ONS, because you can't really, these figures don't really bear detailed scrutiny at any level. But if the measurement is consistent, regardless of how accurate it is, then you can still trust the trend month to month, quarter to quarter, year to year, of course. There was the tiniest shoot of hope for job vacancies because there'd been this pattern of 39 reporting periods, months in a row, where the quarterly vacancy number had dropped. That's been snapped off with a massive 2,000 extra vacancies in the past quarter being reported on. But look, it's a trend that needed to be snapped off. And one of the big messages in the Bank of England report, we're back to about the normal amount of job vacancies versus number of unemployed in the UK. We're back to the long-term trend, or back in that mixer after a huge amount of noise around COVID for reasons that everybody, I think, understands pretty well by these days. Wages also caused a big stir. Total wages, excluding bonuses, up 4.6%, including bonuses 4.8%. But what about private versus public sector? Well, 4.2 for the private sector, 6.6 for the public sector. Quite the gulf, and caused significant commentary from those who are willing to take it out of context. However, I always prefer context, and the context I've chosen here is the past 6 years, so we can capture a bit of the pre-pandemic and a different story is told. So remember those good old days before we knew what a pandemic was? People were still motivated, big companies still occasionally had people to answer the phones, standards still existed. Well, in quarter 3 2019, average wage growth looked like 3.8 for the private sector and 2.8 for the public sector. In 2020, there was a dramatic reversal, but how much do you trust the 2020 data? Well, private sector was up 0.8, public sector was up 3.5. That went into a dramatic reversal after that. Private sector printed 6.5, 6.2, 7.9, and the public sector went 1.9, 3.5, 2.5. So a massive gulf that started to appear there. And of course, Labour caused a fuss when they snapped this off after they were elected, right? But objectively, few could argue that the public sector had had a rough deal over those 3 years, particularly due to outsized inflation, and also certainly parts of the public sector putting in an exceptional shift over the pandemic, not really being rewarded in any way compared to the private sector. So inflation also played its part, as I say. The 5.2 private sector versus 5.8 public sector in 2024 didn't do much to redress the balance, really. But 4.2 versus 6.6 is so stark, it attracts attention. But you can see how far behind the public sector it got. So private sector, last 6 years, to the nearest 0.1%, 40% wage rises. So next time someone says wages haven't gone up that much, 40% on average in the last 6 years. Public sector, 29.7. Inflation, well, CPI was 30.7 over the same time frame, which puts everything into context. But you can see public sector have lost about 1% in real terms. Private sector have gained about 10% in real terms, if you take CPI as the right measure of inflation, of course. So you can see real wage growth in the private sector and the public sector there or thereabouts, really. Okay, back to the ONS. They prefer to adjust by CPIH rather than CPI. And because CPIH is still riding above CPI, thanks to interest rate normalisation and higher rents that lag, just like public sector wages have lagged, that sees regular pay only up 0.5% in real terms on wages without bonus, or 0.8% if you include the bonus when you're adjusting for CPIH. If you're doing it for CPI, you'll be on 0.8 and 1%. Be using total pay adjusted by CPI. So real terms wage rise is just about, but nothing that's going to put what John Major used to call the feel-good factor back into the economy, right? You're not going to feel like you've really gained much ground this year, I don't think, unless, of course, you've been promoted. I'm talking about, your average situation, similar year to year. Okay, having been right into the details, how about we zoom back to that 5% headline figure that caused all the fuss? Is 5% some kind of breaking point? Well, Bank of England's pretty mute, actually, on this point. The last time they mentioned a number for unemployment, it was us getting below 6% during the repair period after the Great Financial Crisis. That was going to be a trigger to start to normalise interest rates. And that was an adjusted figure because it was part of Mark Carney's forward guidance policy, which caused a lot of fuss, but in fact was a pretty darn good idea, in my opinion. But when he introduced it, 7% was the magic number to get underneath, not 6%. Well, when was that? That was as recently as 2014. So it disturbed the markets a little bit because job creation was good at the time. There was a fairly quick lowering to a looser 6.5% or 6% unemployment, please, to ensure the markets accepted that rates would remain nice and low. As that progressed, there was then a referendum, which upset those macro plans and instead required a cut rather than a raise. And there was a mini repair back to 0.75% from the new low of 0.25%, of course, remember, until COVID came and we set another new low. All of that suggests, though, that 5% unemployment isn't particularly problematic. It's more the trend and the pace of change that always causes alarm or disruption. Round numbers, though, are always psychologically important. Then there's the argument that higher unemployment might lead to higher productivity, which is actually based on 3 real pillars. Firstly, workers are acutely aware that losing their job is a pretty bad idea at a time of rising unemployment, and so they try harder. Output per hour is boosted. Secondly, firms are actively restructuring in this environment to try and protect or regain pre-pandemic margins, and so they're more proactively cutting their least profitable or least efficient operations and shedding their lowest performing workers. So that boosts the average productivity of those that remain. And then thirdly, a larger pool of unemployed talent offers a much wider selection of candidates. So, anecdotal evidence here. In my core operation, I have a very limited number of people. There are fewer than 10 of us. So this is indeed anecdotal, but I've recently recruited for a position that I recruited for, again, about 18 months ago. And the applicants are, as I mentioned last week, overwhelmingly people who have been made redundant recently. They've also got much higher levels of experience and are willing to travel further to work. Only one example, like I say, but exactly what you would have expected in this job market. It certainly is not a time where employers will be or should be accepting substandard performance from their staff teams. Now, that's only one side of the argument, and I do feel obligated to stay balanced and present the other side or the mitigating factors. So, in the short term, bad for employees, good for employers, you might say, this bit of unemployment. Long-term unemployment, however, causes skill erosion, and it affects the long-term productive capacity of the economy. High unemployment, people get comparatively cheaper. That actually discourages investment in tech and capital. I'm not sure how much discouraging will be going on in this world of AI we're living with at the moment. But the most important counter is that historical data actually shows the strongest surges of productivity growth are immediately after periods of strong economic recovery, when employment is rising rapidly, not when unemployment is peaking. Not that it has necessarily peaked yet, in my opinion. So it was the Bank of England quarterly breakfast briefing this week for me, and I will talk a bit more about that in the deep dive, but this is a good time to bring up the fact that the bank has 5% at the top of their forecast for unemployment in this cycle. That looks wrong to me, and indeed one of the questions I asked this quarter was, what if the bank is wrong about that? Because it looks like they are. And I referred back to the fact that 9 or 12 months or so ago, the bank's rep had stood at the same meeting and told us that the shock of national insurance on employers' hike would take 2 years to play out as far as the employment figures went. So the current feeling around AI, which is hard to pull out of the macro data, but it does seem that AI is being used for cost control and cutting rather than augmenting and increasing productivity in the first instance. And you could argue that actually that's what the big companies need to do, because they need to be able to show some kind of return on investment that they're putting into AI. And if they can show that by cutting costs, stock market investors love nothing more than a period of seeing costs being cut. So we've got 6 months of full data since the national insurance hike, and we've got 18 months to go. Of course, we've seen the biggest, most significant, hardest 6 months in that situation, but I don't see how this leaves us as 5% at the top of the cycle now. So I asked for what ifs. What if it's 5.5? What if it's 6%? When will the bank act? However that plays out, the bank would cut rates faster. The rep confirmed, but how much faster depends on the underlying structural reasons behind that increase. I'd be extremely surprised now if we don't see 5.3%, if not 5.5% in 2026, but certainty on that will have to come after the budget. Will a number of the initiatives that Labour have announced make a difference soon enough to the figures? It's hard to say. I find their communication so frustrating, insufficient, and almost jocular that it's quite tough for me to be objective. A huge amount is on the success or not of the Connect to Work scheme. It's supposed to bring up 300,000 of the 2.8 million on the long-term sick list back to work before 2030, putting 100,000 into employment a year at the peak delivery time. And this scales up throughout 2026. The jury is out on that, of course. There has to be a correlation between the generosity of out-of-work benefits for the long-term sick and the incentive to get back to work. The question is, how significant is that relationship? Okay, enough. The trend is not our friend, and we don't know what it will do to productivity, although it may well not be all bad. The incentive to work harder is an interesting one, but I would put the most significance of that importance. But I believe very strongly in the Munger philosophy of show me the incentive and I'll show you the outcome. If you looked at the post-2010 period of austerity, it wasn't really definitionally austerity, but you came out of a 13-year period where healthcare spending grew at 5.5% in real terms a year, for example. Fantastic for the general public and totally and utterly unsustainable at the same time. Then you saw a huge amount of the incentive driving the outcome. However, we aren't where we were in 2010. We're in late 2025. And so the start point is very, very different. Okay, the RICS residential market report. Softening buyer demand, policy uncertainty, feeding into a general sense of caution. Modest downward pressure. Subdued backdrop expected to persist. Well, the next 2 months after this report are November and December. So that's definitionally correct, right? But I am going to disagree with the overall sentiment, though, in that I think there's going to be a healthy January bounce because the budget is probably going to be nowhere near as bad as expected for homeowners, particularly for first-time buyers, because if my tip-off about Help to Buy is correct, then it should be a positive one for the first-time buyer part of the market. And property owners who are further down the track in terms of years on the clock will also know more about where they are. That's my sense. The seasonal take from some commentators was a frozen market, although the cold weather is yet to come. But it's on the way, if this morning is anything to go by. But why? Well, the budget, with a variety of the surveyors from the report commenting the impending budget is having a very negative effect and has effectively killed all sensible activity in the marketplace. Those comments are not just from the southeast of the country, by the way, but also from the West Midlands. So it's clear who the surveyors are blaming. But the most relevant surveyor comment might be in the report, feels like the tap has been turned off in the property market right now. So much uncertainty ahead of the autumn budget on 26th of November 2025 and general negative sentiment now in overdrive. People are waiting. And I've said this before, especially in short time frames, they can wait. That's the whole point, right? It's not a big deal if you're talking about a house transaction for the majority of people to wait 6 weeks and see where the land lies, for example. They can easily have been delaying since before the 1st of October, before the budget chat really started to ramp up like it does. And there's plenty of it over the summer. There's a headline every day in August, 1 week, about various property taxes. You know, people want to know where they're at before they make these massive decisions like moving house, right? Within a year, though, the surveyors still see a rebound. Minus 12% is their balance figure on pricing over the next 3 months, but plus 16% see growth over the next 12. So enough, but not resounding by any stretch of the imagination. Tenant demand is down 4% on the balance figure, but landlord supply is collapsing still at minus 33% still being the print. That's the weakest reading since April 2020. The industry faces regulatory burnout for their clients. But I do make this point fairly regularly, though. Larger landlords don't necessarily use agents, but handle things in-house. And there will be more of that going on that doesn't necessarily reflect 100% of the marketplace. Still, those numbers are not good news for anyone, even if some on the left of the political spectrum believe that fewer rental units is a cause for delight. Abolish landlords, eh, Polanski? Watching. The near term's rent expectation balance, plus 15%. So, the market quite clearly continues adjusting thanks to inflation, even if prices are not falling. RICS doesn't necessarily encapsulate this in the way that I do, but the figures are the figures. We're still going to print 2% growth this year for UK property. It's still forwards, not backwards, on the back of a nominally forwards figure in 2024 as well, of course. And RICS recognise that competitively priced properties are selling well. And of course, we already know the cheaper stock is comparatively flying out the door. They don't worry about Band H council tax or taxes on properties over 500k. They're nowhere near those problems that are ultimately nice to have problems, aren't they? So where's the real pressure on prices being felt? You already know the answer. London, the South East and the East. There is mention, which has merit, of the frustration of policy by drip feed. How much is the fault of Labour versus the media? I'm not sure. But if I was in charge, I'd be returning to PERDA, when any discussion was expressly prohibited and any leaks would lead to termination of employment or loss of position. Then you can't blame the media or hide behind it, or a mixture of both. I don't know a single person who thinks that this drip feeding policy of ideas is a good thing for the government or the economy or for the people, in fact. So there's this knife edge feeling from the surveyors, but if you read this report on a regular basis, it's never a cheery report. You're not reading it expecting a pick-me-up. RICS surveyors are by their nature a conservative bunch, and the market mostly hasn't offered great cause for positivity in terms of price action. Step back though. Lots of listings, work to do for agents, lots of sales, solid net sales figures, and likely 1.2 million transactions or so. Certainly 1.15 million this year. Good business if you can get it. Tough year if you niche into top quality Mayfair properties, sure, but there's always a tough year for some niche somewhere. The strapline figure was minus 19%. The house price balance, not far off, minus 17% from the month before, compared to the economic consensus of minus 14%, which will be informed by a better figure in the October Halifax index, for example. RICS didn't see what Halifax did, or they're just lost in the pre-budget malaise. Okay. Growth now. Growth, growth, growth. You remember that? It was promised, it was lamented, it was nearly chanted, to be honest with you, but the report wasn't great. Minus 0.1% for September, plus 0.1% for Q3. August revised, it was 0.1, positive, but it's been revised back to 0. GDP plus 1.3 quarter on year. Real GDP per capita up 0.8% quarter on quarter for the year. Labour have really underperformed in getting any political capital out of that, by the way. Real GDP per capita did very poorly under the last administration. This is actually a great number in context, especially with the backdrop of employers having a tougher time and cutting jobs. There have been 6 previous quarters of successive GDP per head growth, and this one prints a 0, unfortunately, but at least it's not negative. So outside of the headline matters, what else is there to draw out of the report? Well, once again, the JLR cyber attack is back in these reports. This is why there's significant suspicion over the role of hostile states in these attacks. The production output for the entire economy of the UK fell by 2% in just 1 month, which was caused by a 28.6% decline in the manufacturing of motor vehicles. That is a localized but COVID-sized drop, right? What's a stark reminder of risk in our interconnected world. Monthly GDP was down 0.17%, right? A sixth of 1% solely because of that incident. It was a Cat 3 systemic event, according to the Cyber Monitoring Centre. So, There are events that are even more significant than that, assuming the scale goes from 1 to 5, and it only gets a 3. So, a 4 or a 5 might well affect GDP by 1% in 1 month or something like that. Um, but services picked up the slack that production left behind. Of course they did. But zero point 0.2 on the quarter wasn't much to write home about, of course, and it reflects weak Q3 services PMIs, as I reported on during Q3. Finance, tech, no. Arts, entertainment, and recreation grew by 3.5%. On the bright side, at least that means people can afford to consume it. Creative arts and entertainment activities grew by 12.5% on the quarter. But some interesting facts this month, though, on the average revisions as well. The first estimate, of which this is the one that gets all the headlines. That differs from the final figure, which is 3 years later, by an average of 0.28%. So it's absolutely massive when you're slacking around in the doldrums of, we are at 0.1 plus or minus 0.3. So we're actually between minus 0.2 and plus 0.5. And that's just on average. There's actually a bigger range than that, unbelievably. So there's this picture of fragility, but also a bit of resilience in there. But as usual, Labour are not doing as bad a job as the media suggests. But of course, what are the media suggesting? I wouldn't necessarily focus on this, although I made myself very unpopular in some quarters in the past 7 days when I called out what looks to me like clear misogyny in the direction of Rachel Reeves. All I did was ask for commentary to be able to divorce itself from the fact she is a woman to the fact she isn't doing the best job as Chancellor, after all. But that's enough for comments of absolute vitriol in today's world, of course. Oh well, if you don't like that, don't engage on social media is the only lesson. For me, it was just a timely reminder why I've never engaged with X/Twitter. My take is more the government is nowhere near as effective or impactful on the only growth engine in the economy, the private sector, as the media or indeed the government themselves try to make out. We actually just keep calm and carry on. We are British. There was some bad luck out there in Q3, which will be repaired because ultimately cybersecurity looks like the greatest career choice of all going forward. And the private sector will have to innovate to protect these things. Just imagine the budget change at JLR in spending on cyber since August, or at M&S, or other sizable companies who won't have missed this mini shockwave through the economy. The other story here is that the recovery quarter, which will be Q4, the quarter we're in at the moment, will actually look better than it otherwise would have done because of this temporary blip. So there'll be a bounce, a mini COVID style bounce, really. And to close on the growth report, I normally refer to NISA, the National Institute of Economic and Social Research, their prediction on the coming months, and they predict 0% for October, which actually I think will be wrong on the back of the cyber attack coming back. Positive PMIs for October and this rebound effect. And so their 0.2 for Q4 hopefully looks like it might be a little bit low. Let's hope so. PMIs for November will be with us next week. The consensus at the moment is a print around 52. I'm hoping it might be a little bit better than that, although that's how this week's budget reported U-turns, which is not really the right phrase because the policy hadn't really been announced after all. But how they'll impact business, I don't know. There was very clear market fragility immediately after, which I'll talk about. So on to the 5-year gilts. It was a wobbly week. The TLDR side of it, the numbers coming out of the OBR are not going to be as bad as people like NISA were saying. They're clinging to a forecast of 38 billion for the black hole when they were saying 50 billion plus. They've still got it wrong. It looks more like 22 billion or so. And on that basis, income tax doesn't have to go up. So it won't. I don't think it's any more complex than that. The tax thresholds will be frozen for 2 more years. The rest will be made up on council tax, inheritance tax by extending the 7-year taper period, changing the thresholds, pension relief. It's become more of a rounding error challenge than a direct need to put income tax up. This is utter political weakness because income tax needs to go up to afford the public services that people expect from a Labour government. Their PR machine turned their success on waiting lists this week, for example, where the real numbers show less than a 5% cut in waiting lists since the peak, which was actually September 2023. I don't think you need me to tell you what's wrong with that picture, folks. But the markets wobbled because they did not necessarily interpret this as I have done. And of course, this is just my considered opinion. Of course, I could be wrong, and some will disagree with me. There is the appearance, of course, that the government and the Treasury don't know what they're doing. I think it's just where politics meets economics, personally. But the market has reason to see upside risk here, and investors are understandably nervous. There's also irrefutable logic behind the gilt movements, too. If an income tax rise was baked into the yield curves, and it's taken away, well, an income tax rise would have been disinflationary. And so if you take it away, it means inflation will be higher than it otherwise would have been, and so rates will stay higher, not lower. All of this should have been in the real calculations in the Treasury. I'm not convinced that it was, but for the millionth time, Labour should never have said they weren't going to put income tax up. It also wasn't much of a move week to week. We opened at 3.959 on the 5-year and we closed at 4.023, 6.4 basis points. This is not postcode material. The 30s opened at 5.28 and closed at 5.4. Again, getting back into super value territory for me. But the longs were where the bigger jumps were, and so 12 basis points on that yield curve means a steeper yield curve again. The 5-year swap was 3.567 on Thursday's close, although the close on Thursday was 3.912 on the gilt, so we did jump just over 10 basis points in a day. So if we interpolate a swap close at about 3.68 on the Friday, because I only get the data till Thursday on a weekly basis when I produce the supplement, it's still about the same close as it was a month ago, and it still compares pretty favourably to 4.009 1 year ago. But ultimately, the full message there is rates are still relatively stable. So on to the deep dive area. Because I had my breakfast, tasty as it is, thank you Warwick Business School, at the Bank of England meeting on Thursday this week, I had the chance to really see the current scenario in some detail, some of which I'd like to share in this section. I say on a regular basis, the regional rep for the West Midlands must have his patience tried by me, since he knows I'm asking questions as a guarantee. I've already detailed my first one around the fact that it seems clear the bank has once again not got a very good unemployment forecast. The other question I asked is also definitely macro interesting, and I want to share that now. The graph that the rep showed one point of the presentation detailed the following. If you're interested, this is page 46 of the MPC report, if you're keen enough to refer to the direct chart. On the x-axis, time, 2016 to 2025. The anchor, as they always have when they do an index like this graph is Q4 2019, one of the most broadly used indexes in cross-temporal analysis at this time, because of course it represents that last bastion of normality pre-pandemic. On the y-axis, the index figure, and this is about real household disposable income, RHDI, one of my favoured metrics because it's households that pay rent, and if they have real income growth, there is room for rent to grow over and above inflation. And on this chart, RHDI is plotted against real consumption adjusted for inflation. Frustratingly, the bankers used a scale on this graph that captures what happened during the pandemic. So it doesn't do a lot for us. They normally cut the scale so we can see the movements in more detail and basically ignore what happened at the extremes of the pandemic. But that's one of the reasons why I haven't shared the graph itself. You can't see it in enough detail. And they don't give you the raw data from the report, unfortunately. But the cut scale that put the pandemic off the charts would be a much better way to look at this. But anyway, here's what I see in that graph. Real consumption in early 2016 is indexed under 95, 94 and a bit, right? So it's 100 at Q4 2019. It's about 5.5% below that at the start of the period, Q1 2016. And then real consumption, so over that period, over that basically 4-year period, grew about 5.5%. No one learned anything there. That was what it used to be like over a few years, 1 and a bit percent a year, not unusual. But from Q4 2019, real consumption is now still only printing 100.7 for Q2 2025. So we've had 0.7% growth in real consumption since then, 4.5 years. So from 5.5% in 4 years to 0.7, absolute collapse in real consumption growth. Real household disposable income has grown over 5%, looking more like 5.5. So two questions emerge. Where's that money gone? And therefore, where's any growth that we've had since 2019 actually come from? And the second one is the one that I asked, because the first one is answered by the nature of economic analysis itself. If we have more money and we aren't spending it, we're saving it. Economics is simple like that. Consume now or defer consumption for the future, or save. We know this. The savings ratio was a whopping 12% in Q4 2024 for a few reasons, which I'll get into. It's remained over 10% in the first couple of quarters of 2025, which we have the data for. In the old money days, pre-pandemic, 5 to 6% was deemed a fine savings ratio for the UK populace. Many developed nations lived between 3 and 10% before the pandemic. So as so often, we were fairly near to the middle of the road. So where's the growth coming from? And why the question? Well, Macroeconomics is full of identities, and this is one of the most classic equations of them all. GDP equals C plus I plus G plus X minus M. If you've studied economics at any level, it's one you might remember. C, consumption, lives between 57% and 65% of GDP in the UK economy. So if that's only gone up 0.7, right, over the course of those years, you'll see why I asked the question, where's the growth come from then, right? Now, I'll let you into a secret. I knew the answer, but I wanted the room to hear it. Not that it landed with particular impact, because it just came across as a fairly dry exchange between two economists, to be honest with you. But G is more like 19 to 20%. Now, this is not the usual percentage you're used to hearing attributed to government spending. You hear more things like 45%, right? But when we're using the macroeconomic identity here to describe GDP growth, we're normally talking about TME, total managed expenditure. And that's the difference between this is actually government consumption. What's the difference between those two? Broadly, what we call transfer payments, benefits, pensions, interest on government debt. All of that is excluded. And if you know anything about government spending, all of those are at least over £100 billion per year these days. So it's a huge difference between that. We're talking government consumption, because ultimately we're looking at gross domestic product, not when government redistributes money from X to Y or whatever, or makes a transfer payment from the accounting perspective, right? So I, more like 17 to 18%, is what the record keepers call GFCF, gross fixed capital formation. It's just investment spending by businesses on capital goods and also spending on residential property. X minus M is usually a negative, between -2 and -4%, because as a nation, we import more than we export. And this is, of course, the bit that Trump has concentrated on in a way, but not with the direct goal of improving GDP this way, although it could or would, but with consequences, but as a lever, or a lever, perhaps I should say, for Mr. Trump, as I've described many times, including this week. But look, that's enough hardcore macro, right? C hasn't moved. G has, and G is where the growth has come from. If we'd been in a smaller setting rather than the Bank of England meeting, or a less formal setting, I would at this point have nearly exploded with, don't you everybody see the problem with that? Any problems that anybody sees there? Well, the government spending trend basically creating all of the growth since Q4 2019. Well, it's not a sustainable situation, is it? 6 years later does seem an appropriate time to bring it up, no? We need consumption growth. And once again, it leads me to conclude that the government focuses on the wrong things. Imagine if we could unlock the level of consumption growth back to where we were before the economy went into the pandemic period. We'd be in great shape. 2% growth and above would not be a problem in the shorter term. A 5-year period, which would absolutely fix the OBR forecast period. Always thinking about playing the game as usual. So how? Well, firstly, address savings. Why are people saving, and what do they say about it? Well, the bank is packed with smart people, so this is the next question they ask in their report. Although, of course, they do not seek to influence fiscal policy by definition. But what are the changes, and why are the people saving so much more than usual? First up, rebuilding savings / greater worry about emergencies. The fact that they mash those two options together deeply upsets me in this survey from an integrity of surveys perspective. This is the family fortunes top answer, Steve, right? So why is it like that? Split it into its two component parts. I personally believe this is the manifestation of consumer worries over the budget. 38% of people answering this question in the second half of 2025 picked this option, but it hasn't been said. The problem, as I frame it, the people do not yet trust Rachel Reeves and the Labour Party. Now, we've got to be as objective as possible. Let's just go macro. They said growth. They said they would cut regulation. Instead, more regulation seems to be strangling things. They freed up planning. They've got a positive forecast from the OBR on that front, even though planning is by no means the only problem, as I've been saying all along. Gove's regulations and legacy in urban development, Fire Safety Act, the Building Safety Act, they're causing so many problems, it's ridiculous. Regulation easing in the city is moving quietly in what I'd argue is probably the right direction, and expect that to manifest itself in higher profits, but it will stay quiet, the city, because why would they want to talk about it? They'll just quietly carry on making more money. But at the same time, all properties needing solar panels or new builds, one of a couple of dozen examples I could pick out, to be honest with you, are working in the other direction. Leaning on the lenders to lend more to first-time buyers makes sense, of course, within reason. Nobody wants ninjas to return, but many of us wouldn't mind a self-serve mortgage, let's face it. Anyway, what are the other options on the savings survey in order? Household income has increased. 33% of people answered that. Well, that's positive, but it doesn't tell us why they aren't spending it. Presumably because they've got enough. Well, now compared to H1 2025, fewer people are saving for a big item or a deposit. 25% of them has come down to 22. Higher savings interest, well, that's come back, of course, but it's come back from it was higher in H1 and it was higher the year before again because the base rate was higher. So the short-term rates, your 1 years, your 2 years, your inverted yield curve, it was all more attractive for people ultimately. It also incentivizes saving less, which gets people to spend rather than save. That's why I support a cut in the ISA allowance in the budget coming up, for example. 21% of people said they were saving because of attractive rates. It was 28% in the first half of 2025. Now, there's a new answer to the survey next, lower cost of essentials. I was surprised to see that up there, but clearly the transitory part of the inflation wave is over, and so people have seen the ability to save. The rest of the reasoning hits the 10% or so barrier, so I think that's less worrying. The other new answer compared to the first half was, I expected taxes to rise or benefits to fall, scoring around 11%. Job loss concerns are up. Understandably, people aren't stupid. Housing cost increases factor about 13%, but that's fallen from 16% in the first half. So from a policy perspective, make fiscal policy, give monetary policy the room to cut rates. But there's more to it than that, much more. Take control of the bond markets, directly and indirectly. I've spoken of my desire to unwind quantitative easing in a very different way by allowing the Bank of England to swap some bonds out, dispose of some shorter term bonds, use the money to buy some longer dated bonds. The shape of the yield curve at this time makes this a profitable trade. It needs to be done properly, cautiously to an extent, but yield curve control light, as I would call it, although I wouldn't call it that if I was in power, I'm not going to lie, is an opportunity to right the wrongs of what's been done when it comes to quantitative tightening, which I've spoken of many times. But this is a minor part, though, really. It should just be done because it can be, and it can save the taxpayer many billions of pounds. We don't need any more reason than that. The other side is talking about confidence in the UK, right? This is what you need to be doing. This is the Boris boosterism that he used to do so well, regardless of whether he knew what he was talking about at the back end of it or not, right? Give investors confidence that feeds through into the bond markets. Labour have sort of tried this, but what's ended up happening is that their political puffery or backing themselves into the wrong corner has badly damaged their credibility. Respect the intelligence of your audience. Reeves went to Oxford, and many of the people who are involved in the funds that listen to what she and the Treasury say also went to Oxbridge. They need to know you're on top of everything. They are living in the real world. Now, as an example, whilst writing this week's supplement, I did some AI-powered deep research into the Connect to Work scheme, as I mentioned earlier. I hadn't even heard of it, frankly, and could it come up with 300,000 jobs over the period in question by 2030? I always try when I'm using AI to make my prompts as objective and unbiased as possible. I know the likelihood that I'm unbiased, but everybody else is biased, is unlikely or indeed impossible. However, I do spend a lot of time and effort on being unbiased, and I'd like to think I do an okay job. I asked, amongst other things, how realistic or not the 300,000 jobs number was. This is what's going to be created by bringing people off the long-term sick list with this Connect to Work policy, supposedly, right? What came back from the research? You can see why I asked it, I hope. I consider myself to be an expert in the UK housing market, and I knew, as did many other people, even with half a clue, let alone the experts, that the 1.5 million homes number was a complete lie. But of course, it was also a lie that every single other party told as well, of course. But I knew it had no chance. The language that the AI chose in its deep research write-up, highly unrealistic. The additional employment is expected to be between 45,000 and 105,000 over the period, a success rate of 15 to 35% of the population that are being supported by that scheme. In fact, that makes the house building numbers look okay. We will, after all, hit more than 50% of the target as pretty much a guarantee over the Parliament. We won't build fewer than 750,000 houses, but the vast majority of them, of course, are being built by the private sector, And Sadiq Khan's housing start targets in London are currently running at about 6% of their number for 2025, the last time we looked at the figures in the supplement a few weeks ago. Yes, 6% of the target, so they're short by 94%. So get the interest rate down organically with better policy. Don't treat it as the only fruit because you don't even set it. But lower interest rates give room for more consumption spending. Get consumption spending up, create growth. There's major league catching up to do. Let it happen, and a decade of relative prosperity could be ahead of us. Give confidence to the people and the businesses, and it would be so much easier to see a path forwards. Now, I suspect you might listen to that and think, well, that's great, but it's not happening, is it? Well, would Nigel Farage do this? Would Zach Polanski, currently second in many polls? These are the big questions. But before that, would Andy Burnham or Wes Streeting or someone else do this? The fact is, I think that most of them would do a better job than Starmer and Reeves. Right, I'm not going to spend any more time on politics this week, but I do just want to make the most of the rest of the bank report to focus back on unemployment. In spite of the bank's overall position and their, in my opinion, incorrect forecast, they do recognise deeper into the report that 5.5% unemployment is quite likely using some models. Well, that sounds pretty realistic to me. They also conclude that the vacancy rate is broadly in line with its historical relationship with the unemployment rate, as I said earlier. So the number of unemployed as a ratio to the number of job vacancies there are pretty much back to normal. Well, good news from a pandemic disruption perspective. Fewer vacancies will emerge, though, if this new Labour bill becomes an act as it stands at the moment around workers' rights, of course, because SMEs are going to be much more nervous of employing people, and the spend on recruiting will have to go up and up to try and weed out the weaker candidates ever more than before, because the cost of a bad one will be even higher than it already is. The distribution of risks to the outlook for the unemployment rate remains to the upside, is how those who speak in regression model language put it in the report. So there's an acceptance that higher unemployment is perfectly possible and indeed more likely than lower unemployment, or at least that the relationship is not a straight line. Small to medium-sized enterprises in their overdraft are also back to pre-pandemic levels. Their cash balances in real terms are slightly below where they were in 2019, but it looks like more evidence of a return to normal. What's needed, of course, always is for business planning, is stability. The exact opposite of all of this budget speculation, naturally. The official participation rate is also back to normal. What percentage of the population has a job? You see the pattern, evidence upon evidence that the pandemic impact on the labour market is effectively over. Hybrid working is different, of course, but then, of course, it saw a huge rise and then a bit of trimming over recent years. Participation has changed by age, though, interestingly. The bank rep highlighted this in the report. Participation at 65 and upwards is up. People are working for longer. 50 to 64, it is down. Presumably, it's got something to do with that bit of early retirement that happened thanks to COVID, where people kind of stopped and got off the wheel where they could. In younger age groups, it's also down, which is a spoken of issue. Unemployment of young people and the million or so that are out of the workforce, but not in education or training either of that age. That's such a multi-generational damaging factor that I really hope it's given due consideration by not just this government, but following ones. So, as often, I've fixed most of the problems that I see, and I sit here in frustration that it isn't the way that these problems in the economy are attacked by the incumbents. Oh well, perhaps one day they will listen to the supplement. With that in mind, can I please ask you for an extra effort in likes, shares, and comments this week? Please, folks, and subscriptions as well, of course, much appreciated. So, as I draw this week to a close, the next property business workshop is filling up. As we turn our eyes to 2026, our tickets are available. We're going to start the year with a bang, discussing strategic planning and how to make the most of the next 12 months with some of our own methods and takes on productivity and time management alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping, and group accounting. This is about measuring asset performance. It's not about how to use zero. It's how to make the most out of your financial information. What should you be seeing monthly, and how should you interpret it properly and use it strategically to grow your business safely but quickly? Super early bird tickets are available, a genuine 20+% discount off the face value. And as always, we will have some real life case studies about our own experiences and close with our no holds barred Q&A. If you've got something individual to consider and you'd like to talk to myself or Rod about it, get yourself a VIP ticket, join us for dinner. a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property business at the moment. That's the best way to get a substantial conversation with myself, Rod, and the other attendees who will be experienced property business people. Join us on Thursday, the 22nd of January 2026 in central London. Link in the show notes, tinyurl.com/PBWNINE. But above all, please remember, keep calm, always listen to the supplement, and carry on. There will be opportunities abound this year and towards 2030 and beyond. The landscape has been set for a surefire bull run. It will be slowish and it will take a little while longer while things get off the ground. And the amount of stock around is still keeping things a little bit suppressed at the moment. But as the market is very clearly continuing to improve slowly, it's a case of here we go, in my opinion. Thanks for tuning in, folks. I do appreciate you. Leave me a comment. I'll try and get back to you.